Welcome to Macro Atlas. Today we're going to be discussing the dangerous macro setup that Bitcoin is facing. There are exactly 8 macro forces that are in play, and those include the liquidity deceleration. So the Fed officially has started to print less money. Of course, higher interest rates, and they seem to be going to be higher for longer. There's even like higher probability now, higher than ever, to increase interest rates by September. We also have higher inflation expectation, rising Treasury yields, of course, weakening S&P, strengthening DXY, Bitcoin cycle, and Bitcoin's market and price structure. To keep this video not too long and condensed, we're going to just run over the key facts, but all those factors are discussed widely on the channel and discussed more in depth. So this is going to be like an overview. Maybe it can help you in understanding the factors that you should research and study for your own analysis. And I hope this video helps you as much as it helps me have higher conviction on my directional bias for Bitcoin and etc. But before we start, I'm Mo. I'm a crypto and macro market speculator. I've been a speculator for the past 5 years professionally, but I've been in the markets for even longer than that, 7 years. And I've even read a lot of books and been interested on how money works and economies and geopolitics since I was very, very, very young. I would say around like 15, 16, right? So this is where my expertise comes from, and I've been profitable for the past 3 to 4 years, and I was able to turn a small portfolio into 6 figures this cycle. So I hope you enjoyed this video, and if you do, please like it. And if you want to watch more content like this, consider subscribing. It would help the channel a lot. Yep. Let's start with the most important one. The liquidity deceleration phase, the new regime that the economy is going through, specifically of course, the US, right? Previously, the Fed has been printing around 2.7 billion a day, and this was due to the problems in the private credit sector, right? But the private credit sector has seen signs of recovery, and therefore the Fed recently started to print from that phase, right? Around mid-April, well, they were printing around 2 billion a day, and recently with the new schedule that they have released, they decreased it even more to 1.3 billion a day. This, of course, pulls out the liquidity that Bitcoin has been using to fuel its rally. And usually after phases like that, the Fed stops printing liquidity whatsoever, like in this outline zone right here, right? They've been printing here 4 billion a day, and then they printed from 3.5 down to 1 billion. So this is the deceleration phase that we're going through. And then they stopped printing liquidity, which led to that next leg down of the bear market phase. And that coincides with the current market structure everybody approximates. Basically, we've talked about this way before, but now everybody's saying, oh, we could be here. We've talked that we could be here 5 months ago in different videos, right? So that phase maybe coincides with that phase. It has a lot of similarities in terms of timing, how the Fed behaves, and of course, price structure, right? So that's the first one. The second one, we are facing fears and higher probabilities of increasing interest rates rather than decreasing them, right? So this is bad for markets on many levels, especially risk assets. Higher interest rates means less liquidity in the markets, slowing economy, slowing GDP, higher borrowing cost, and etc. Right? So that leads to higher unemployment rates, and since we have unemployment fears and pressure for a very long time, this just doesn't make the picture look any better, right? So that continues. The probabilities of increasing interest rates just continues to go up and up and up, and continues to be sooner than expected, right? So increasing interest rates was going to be around the end of 2027, right? Now it's September 2026, which is accelerating very quickly to the wrong side of the bulls, right? We're also having higher inflation expectation, and some of that can be attributed to tariffs that were imposed. Some of that can be attributed to, of course, the elevated oil prices. Right now, we're reaching again the range lows, but I think we might be seeing another rise to the upside, which will put higher pressure on inflation and therefore higher pressure on Bitcoin's price. I guess you guys have seen, and if you have not, then I do recommend checking it out. But core inflation has ticked up as we had discussed previously. We said we would see an increase in core inflation due to increased oil prices around here. We did not expect it to even increase in that period. We said maybe we stay on the same level or just increase a little bit, but we increased here and then we increased by a lot over here. Another worrying one is, of course, the headline inflation is skyrocketing, and of course, signs of inflation rising first appears in the headline inflation, and then it trickles down to core inflation as headline inflation calculates energy inflation directly in the calculation, right? But core inflation takes a little bit longer than that, and the, of course, producer price index has increased as well by a lot based on the last reading. So inflation is looking like it's going to be sticky, which is bad for risk assets, right? Rising treasury yields. Well, there's a worrying market structure being played out by 10-year treasury yields. That going up is not good for risk assets, as people will start to have an opportunity cost. Maybe I should put, they would say something like, maybe I should put my money in safer assets such as treasury yields that give me good returns, and the higher return, then the more inclined they would be to do that, right? And another thing you should watch out for, if the 30-year goes up while the 2-year goes down, then that signals recession fears, right? Because people are less optimistic about the near term than the long-term future, as they would be expecting some kind of recession fears. That what it means when the 30-year goes up and the 2-year goes down at the same time. When they both go up at the same time, it's also not good because, of course, people will be putting their money in 2 years and 30 years. But nevertheless, if this goes down aggressively, then watch out that it's a recession signal, right? And right now we're testing that major resistance line. Similar to the 30-year, we actually retesting the previous resistance to support, and that is a dangerous structure being playing out here. Let's go to the next one. The weakening S&P, of course. So based on the 4-year cycle timing for the stock market, and it does work, even not only in crypto, but also in the stock market. Like, as you can see in this analysis, we do top approximately every 4 years. And right now we had approached that deadline, right? And if you take that snippet from the 2000 dot-com bubble, then you do see we are approaching the near high range of that snippet, right? And I'm not saying that we could continue following it. We could break from that trend anytime, but the trend is referring to the end when it bend, as you know, many. I think it was Etsikora who said that, the famous investor. So right now we're approaching the high end of that range, and we should be expecting a drawdown according to that snippet if we continue to follow it. It should be tracked at least, right, around July, right, mid-July. That should start to head down approximately, if the price continues to follow the snippet from the 2000 dot-com bubble. Strengthening DXY. So I've done analysis on that a long time ago, which the DXY had been following surprisingly well. Usually, if you can see that just quickly, that the structure how it plays out is you get that parallel channel right here, upward channel. We manipulate below and above it until we break below it. We find the bottom, and then we go up either slowly to the upside or sometimes aggressively as such, right? But nevertheless, the DXY going up is bad for risk assets such as Bitcoin. That's why it's a red zone here. The red zone corresponds to Bitcoin's bear markets. If I can get Bitcoin's price right here, just for you quickly to see it. New price scale. Yeah, you see, bear markets coincide with that red zone. And this could be just the next major red zone that we will see. So that's how the structure plays out, right? As you can see, we did form a parallel channel upside, manipulate below and above it, break down, consolidate a little bit at the range low, and then slowly or aggressively build up to the upside, which is bad for risk assets such as Bitcoin. The next one we're going to be talking about is the Bitcoin 4-year cycle. So we're going to merge the Bitcoin 4-year cycle with the market structure of Bitcoin right now, as they are both kind of related in a way. Everybody knows the 4-year cycle for Bitcoin. If you don't, I do believe you should watch maybe a video that specifically outlines this theory in more in a complete form that is more detailed. But approximately, we do find the top happens every 4 years, and the bottom happens also every 4 years, right? It's a 4-year cycle, and usually from the top to the bottom, we approximately need around 364 days, but one cycle was around 410 days, right? And that's the first cycle. But approximately around 1 year from the top, you do find the bottom, and that means we are still not in time for the bottom, right? Based on the 4-year cycle, 364 days, or let's say 410 days, the maximum range of that will put us in November, but 364 days, that would put us around October. So October, November is where we should find the bottom. That's one thing about the Bitcoin 4-year cycle. We usually draw down around 70 to 80%. Okay, but I think there are diminishing returns, so there should be diminishing drawdowns, and we discuss why we think it should be around the 60% range in a different video with different theories. So around 50%, around this, 50,000 to 35,000 should be historically the bottom range for Bitcoin, right? Market structure wise, well, remember we talked about the accelerating liquidity and how that's the war one, how we could be in that zone right here comparing to the previous market cycle. Well, surprise, surprise, that comes up again in the 200-day moving average and the market structure that is playing out. So in the previous cycle, we went down, first leg down, we did the parallel channel as such, and then we, of course, rejected of the 200-day moving average, and then we went lower for the second leg down of the bear market. Usually there are 2 leg downs every bear market. Now we're playing something similar. There's a parallel channel right here. That's the first leg down that happened here, right? So that's the first leg down. That's the first leg down. This is somewhere like as such, and we're having a parallel channel to the upside. Let me just clear some of that out, right? And then we, of course, will get rejected by the 200-day moving average, and the next point is actually approaching. We should break that channel, upward channel. Once we break it, then we have higher conviction that the market structure is playing out, and it's playing out in a correspondence with the macro factors that are aligning against Bitcoin. The price tells you that the timing and that something is happening, but the macro just increases the conviction that this is the reason why the price has that. But the price usually reveals things earlier, and that's why I look into macro factors after I check the price, and the price tells me something, right? So you read the ticker, after the ticker tells you something, we go find the reasons. This is how my approach works, and it works thankfully wonderfully so far. So yeah, the next thing that should be playing out is if we continue on this path is just the continuation to the downside, right? And usually the second leg down is the most severe leg down of the bear market for the whole bear market phase of the 4-year cycle for Bitcoin. So if we drop, we should see something, maybe a retest, maybe not, maybe a slow grind, maybe a heavy drop, who knows, but that's what the market structure says. I hope this video had taught you something and you had learned and it helped you like it had helped me with increasing my conviction on the markets. But of course, remember that markets can stay irrational longer than you can stay solvent. So make sure if you trade, you emphasize risk control. All right, risk management is very important. And remember that this is just for educational purposes only. So there's no financial advice in this video, but just some starting points or midpoints of your research to have higher conviction on your trading ideas. If you like this content, do please leave a like. And if you want to watch more of that, do subscribe, because another video we're going to do is actually analyze all the previous war periods and see how it affected the markets, right? And then we can understand how maybe the current situation in geopolitics, what we can derive from that, and how can we make better educated investment decisions. So if you want to see that video, make sure to hit the notification bell so you don't miss it. It's coming out soon. And trade safely, my guys. I'll see you in the next one.